Is it too late for me to do Roth conversions? Well, that's what we're going to talk about here today. I get this question a lot, and I did a blog post on that just this morning, as a matter of fact. Roth conversions while taking RMDs? And so let's go into this. This is part 4 of my series on when to do Roth conversions. So we got married people first. We're going to do married people with pensions, married people without pensions. Then we'll go down to single people with pensions, single people without pensions, single people with RMDs, single people while they're working, married people while they're working, the whole thing. So let's dive in this. I get this question a lot. The premise is a retiree who is taking RMDs, required minimum distributions, which means he or she is over 70 years old. He or she doesn't think they'll have enough time left to live on this earth in order to benefit from tax-free growth of Roth conversions. But they figure they'd ask, just in case I'm missing something. Well, they are missing something. They're missing a lot. So the scenario, we have a married couple, husband is 70, wife is 66. They'll both live until they're 90. Husband has $500,000 in a Roth IRA, invested solely in the S&P 500 index fund, VFINX. Expected returns on the fund are 7.4% with a standard deviation of 16%. Husband also gets $30,000 in a pension with a 100% survivor benefit with no cost of living adjustment. Husband's primary insurance amount, PIA, is $2,900, and he took his benefit at full retirement age of 66. Wife's PIA is $1,000, but she took a reduced benefit at 62, so her spousal benefit will be reduced a bit too. Their monthly expenses are $4,000, which is all inclusive. I'm not breaking down the individual components for spending here. We're just saying that $4,000 a month is what they need to live on. To live on. And so we're going to increase spending each year by 3% a year. So let's dive into the Right Capital software and see how it shakes out. Before Roth conversions, first thing we always got to do is make sure they don't run out of money. So you can see here, not only are they not running out of money, there's a 100% probability of success, and given the 7.4% annual rate of return with a 16% standard deviation, they leave $3.027 million in today's dollars, to their kids at death. And that's the median amount that they're leaving. Not one time in the thousands of scenarios run do they run out of money. In fact, they left a median liquid net worth of over $3 million, but there are taxes to be paid. And you can see here, the total taxes here are $454,000. You got the age brackets here, and you can see again, the tax payment. We got a $26,000 tax payment when the husband dies in 2039, and then the tax payment goes up by $10,000 to $36,000 in 2040 after the husband's dead, and yet the income drops by $20,000. The widow's tax trap. Here's a visual of the tax rates. You can see here, it's just a ladder or a stair step essentially. We're about 7.5 here, about 10, 11, 12, 13, 14, 15, then up to 18, and about 20 by the time the wife dies. Of course, one of the main drawbacks to doing no Roth conversions is that a significant amount of the assets left to the heirs will be taxable as ordinary income. The next graph shows how their legacy is broken down by account type. And you can see here they're leaving 3.703 on average million to the heirs, of which 610 is traditional IRA, taxable as ordinary income to the heirs, but the 3.093 is in a taxable account, which is tax-free to the heirs upon inheritance. Remember that. The heirs inherit taxable account tax-free, but the traditional IRA is not. They'll have to pay tax on the distributions from the account as ordinary income. Now, be advised, while the taxable account is tax-free to the heirs, the husband and wife did have to pay tax on distributions as they're received each year. And the following 1040 shows an example of some of the taxable distributions. Here we have $39,000 of ordinary dividends. Not much in taxable interest because it's all in the VFINX. But again, that's pretty significant. $40,000 of dividends, and there could possibly be some capital gains as well. Obviously, in VFINX is probably not. All right, and then we have $39,000 on top of 85% of their Social Security taxes. So they got $199,000 is their AGI. Subtract the standard deduction and the personal exemptions, or taxable income is $161, which means $26,000 is their taxes. Now, let's see what a situation looks if we convert to $50,000 a year in a Roth. All right, the median liquid net worth is a little bit higher, only $5,000, but it's a little bit higher. But still, higher is better than lower, that's for sure. So you get 100% probability of success with 3.032 median liquid net worth left. Total tax we paid, $315,000. And the interesting, here's our planned distributions, and here's that big fat goose egg of zero, no planned distributions. So tax payments go way down to the extent that they got pension income and whatever dividends and capital gains they have. That's it. So their taxes go down by $115,000, which is 25% decrease in total taxes. That's not bad, man. That's not bad, on top of leaving a higher liquid net worth. But notice something else. We have no planned distributions, no RMDs, because everything is in a Roth IRA. So there's obviously a lot to be said for Roth conversions, even if the entirety of the benefit isn't seen on the tax return. Because don't forget, no RMDs mean less income tax to pay, less potential for higher Medicare premiums, more Social Security being taxed with less Social Security being taxed, I should say, if you don't have RMDs, as well as having to pay taxes, not having to pay taxes on qualified dividends and long-term capital gains. So it's crazy. But pensions, again, do put a tax for. Here's a for because the pension income of $30,000 will wipe out any standard deduction. So any taxable income above that, i.e. Social Security, will be included in a taxable income for sure. All right. So let's compare the 1040 from 2039 when they did Roth conversions. You see only $20,000 of qualified dividends, taxable. Only half of the Social Security subject to taxation, $46,000 subject to taxation on $82,000 of Social Security. And the total taxes, their total income, taxable income is only $59,000, which means their total taxes are only $7,393. If we go up here before the Roth conversions, taxes are $26,000, 85% of their Social Security subject to taxation, and then you have $40,000 of dividends taxes. So half the amount of dividends being subject to tax, $30,000 less of Social Security being subject to tax, and a quarter of the total income tax, which is nuts. And then according to the what they're leaving to their heirs, they're leaving $1.5 million taxable to the heirs. 2.153 is in a Roth, and again, the taxable, because the heirs inherited tax-free, is completely free of taxes at death. 3.688 million on average is left to the heirs, all tax-free, whereas they look up before, 3.703 is left to the heirs, but again, a good amount of that is subject to tax. So they're leaving more money tax-free. Net of taxes, absolutely more money is being left to the heirs by doing the 50,000 Roth conversions, even if they are at RMD. So the answer to the question stated before, is it too late for me to do Roth conversions? Well, if you're paying 25% less in tax over your life, leaving more to your heirs and leaving them with no taxes is important, then I can confidently answer no. It's never too late to at least consider Roth conversion. As always, you go to my website at Heritage Wealth Planning, you click on Connect, and you can sign up for the blog posts I do here, which I'll post this later on as a blog, at least a link to this article. And my blog posts are different than just verbatim what I just posted right there. So if you want to sign up there, let me know. You click down here, select the option. What is that you want? If you do put other in, please put a note in there, because I've gotten a bunch of people just say other, but I'm not sure what that is. So please put a note in there. All right, let me go see what's going on with Pablo. We'll see you next time.